Welcome to my Trading for a Living challenge. And you can see on week 8, I made $2,807 in that week. And as you can see, it is the highest amount that I've made since I've started this challenge. And that is mainly down to making a few small adjustments, not only in my trading strategy, but also moving the account to a margin account. So what we're going to do in this video is walk you through what margin changes we've made, the new trades I've placed, along with looking them, how they look on the charts, how I'm managing them, and the tweaks in my options trading strategy. And if you are brand new, you can click the link down below, which has the full playlist that goes through the weekly videos all the way from week 1 about how I've managed this actual portfolio and how I've managed to generate in 28 weeks. So make sure you smash that subscribe button and gently tap that bell notification if you want to learn how to trade and invest with options. So let's get right into this video. So last video, I talked about that I moved into a margin account, and in week 28, so this video is where I'm going to deploy a lot more of that cash to start bringing in more income through option premium. So you can see here that my $125,000 account has doubled in terms of buying power. I am trading at the moment, actively investing $94,000, which is 38% of the portfolio. But I do have $155,000 of capital left to deploy. Now I'm looking to not deploy any more than 50 to 55%. Always good to have cash available to help my margin position if positions go against me, as well as having the cash available to put on new trade if I need to do that. So if we have a look at week 28, as I mentioned, it's my highest amount of premium. And again, we'll go into all the details, but part of it is what I've done is I've extended my expiration date. So I've added more in time intrinsic value to my trade, which results in higher premium. Therefore I get more income. So we'll go into all of those details, but as you remember from last week or the last month, I only made $741 and I was really struggling to anywhere near my goal, but I managed to smash it out the park here. And again, it might seem like I've just deployed cash willy-nilly just to generate this number, and I could generate 10, 15,000 with 155,000. I haven't done that. I think I personally deployed this, the money I have deployed, to protect the positions I've got, as well as some new positions with some logic behind it. And that's made $3,500. Again, missing the target of 4.1K, but what it has done has let me hit my minimum $2,500 goal to make sure that rent, food, expenses are paid for. I did spend 1.5 hours on this. I make it sound like that I spent a lot of time, but 1.5 hours to go make 2.8K. I don't think anyone's complaining on that. And that's because, again, I've got more trades to look at, more thinking to power to do on adjusting strikes, and we'll go into that, all the good stuff. We're now down to 10% now. Last time we got to 10% was in week 24, so 4 weeks ago. So I'm quite happy. Someone said to me 28 weeks in, you'll only be 10% behind a 9-to-5 job and do it in 5% of the time, then I'm not complaining. So overall, I'm quite happy with where things are in the portfolio. Not happy with some of my positions, which is a good segue to go through the position. Now, for those who have been with me for a while will know that I have a set spreadsheet or a set tab that I went through all the trades. That's going to start getting messy now because I'll be doing more trades on the same underlying using different strategies. So I thought this would be the best way to do it. I might change it as time goes on, but as of now, from a visual perspective, to walk you guys through on what's actually going on here, I think this is the best way to do it. So what we have here, we have the week numbers, and again, I've not added in weeks 1 to 10 or some of the other weeks because it'll just make the spreadsheet too long. I will do it for future weeks, but all the legacy stuff's in one of the hidden tabs on this. But like I said, you don't really need to worry about that. All the numbers all link up to this front sheet, and I'm just showing the trades that actually matter as it currently stands. So then we've got the strategy that we'll be deploying, whether they're stock positions, whether positions open or closed, the number of contracts or options, buying or selling calls or puts, strike price or assignment price, premium collected, expiration day, buying power, and notes. So for Tesla, we've got 3 strategies on the go. The first strategy, which really isn't a strategy, is more I've got to sign some shares, is I own 300 shares of Tesla at $282.50, and again costing me 42.3k in buying power to hold those positions. And what I've been doing is selling covered calls against the long stop that I've had, and I've had the 115 position for a while, and as you can see from the chart, Tesla has been on this massive bull run as of late, and therefore price never got back to my $115 strike. So I've been rolling this position at the 115 for a while now, and with the additional buying power, I've used the opportunity to pay a debit on the roll and push my strike up. So what I've done is I moved my strike from 115 to 120 and paid a debit of $780 in premium. And what I've done is I've moved out from February to March the 17th. And you'll see in all my trades now, what I've done is, one of the tips I've done on this is extended the duration, and I'm using the monthly cycles. So March the 17th is the monthly expirational cycle for options, and I'll be looking to manage these positions around the 21-day mark and rolling these options into the next cycle into April. Now, one of the questions you might ask is, how are you going to make some weekly income? One of the ways is through adding new trades. And the second one is, with an example I'll show in the Tesla situation, is by adjusting my position within the current cycle within a given week. What does that mean? So what I've done is, like I said, is I've closed down this, what I'm calling a covered call strategy, which is what it was. And I've opened a new call at the 120 strike. Now, the reason why it's classified as a short strangle is what I've done is I've sold a put against the call. Again, for the same amount of contracts, and I obtained $1,275 for that. So if I take all of those trades, the rolling of the covered call into a new covered call strangle position and the new put, I made a credit of $498, all expiring on March the 17th. Now, when I placed this trade, Tesla started to go even higher. What I did is I rolled up my put closer to the strike price. So what I did is I bought back the put option for $528, and I rolled up my strike from the 135 to the 156.67, and that netted me an additional $777 credit. What I can do is, as the weeks go by, if I have a position that's going in my favor, and what I can do is I can move my strike up or move my strike down, whether it's a call or a put, in the same expiration cycle. And every time you do that, you will generate a credit. So therefore I can keep playing around and manipulating my strikes to generate more credits. And therefore that's more premium coming in through the door. Now this position here is, so I've got, if I look at the two open ones, I have got the 120 call and the 156 put. Generally, when you're selling a strangle, your call is at the top and your put is at the bottom in terms of strikes. So you can see here, a short strangle, if I go back to here, this would be a short strangle. The put's at the bottom, the call's in the strike, and ideally the share price would be in between your strikes. But because I've got this deep in the money call, I've had to go what's called inverted. So it's an upside down strangle, or whatever you want to call it, where the put is higher than the call. Now, my plan is to roll this position. What I'm about to tell you doesn't really affect me in any way. Best case scenario is, by expiration on March the 17th, Tesla falls in between my strikes. Now, by going inverted, you have locked in a loss of the difference of your strike. So 156.67 minus 120, I've locked in a loss of $3.6K. And obviously you're meant to minus all the credits and stuff that you've got. And I'm probably up on this position if that was the case. But because I'm not planning on exiting this position, I'm planning on rolling this position to the next expiration cycle. And eventually I'll look to take off this inversion. And again, I'll just manipulate this so you can see. I might move to something like this. I might move this here, or I might move it to a straddle position, or I might move it to something like this. This might be my new position in the next expiration cycle, trying to get closer to price, a traditional strangle where the put is lower than the call, and waiting for Tesla to fall in between my strikes. So that's what you can do with undefined risk options, is be very manipulative, if that's the right term, of your strikes. So that's this position here. Again, my plan is to roll this up to hopefully the 125 if Tesla continues to fall, and adjust my put to offset any debit I'm going to take to move my strike up. In conjunction with this, I've opened a brand new trade. I sold one contract and I sold a naked call at the 250 strike, which you can see over here. What naked call is, all you're really doing, similar to a covered call, but I just don't have any shares as an offset, is I want Tesla to stay below 250. That's all I really want to do. And you can see here, Tesla's down 1.12% here. What I could do is I could do another adjustment and move my call strike down closer to the money. So by moving something closer to the money, I'm going to pick up a credit. So I can move from the 250 to the 240, for example. I could generate, I don't know, an extra $100 in premium, let's say. But again, this is how I can manipulate the strikes to keep bringing credit through the door, which will ultimately help my break even, or just roll for perpetuity, to be honest, and keep banking credits and living off that income. So that's probably what I'm going to try to do here. This what you can see here, we got your 300 shares starting 282.50, my short call at 250, and an inverted strangle. So those are the three positions that I have on Tesla. Now, Meta is a very similar situation. So I own 200 shares of stock. I got assigned at two different strike prices. So the average is 156.25. Oh, sorry, I just wanted to say in terms of buying power, sorry. So my two open positions, my buying power on the call that I have is 0 because I've got stock to cover it. On the put side of the strangle, it's 7K in buying power, and the short call for one contract is 2.2K. Yeah, Meta, I've got 200 shares. A similar situation, I've got a deep in the money call. So if I go to Meta at the moment, I did the exact same thing I did with Tesla, is I had the 100 call. And what I did is I closed out that 100 call and I opened a new call at $105. So I rolled the strike up by $5. And unfortunately, that cost me $930 because there's two contracts. So 930 divided by 2, $465 to roll up by $5 or $500, which is still a positive trade in my view. So it cost me $930 to make this roll. And what I did do is I again sold a brand new put position, again inverted, higher than the call price of 105, and I generated $770. So overall, that cost me $160 to basically roll up my calls to 105. So here you've got the short call at 105, and there's my short put over here. And you can see that Meta's all the way up here because of earnings, and we've got this missed pivot level for February, which I don't think will be hit. But now we're stuck in this kind of range, looking to break out one way or the other. We look at where we are from a technical perspective. So we are extremely oversold here, overbought, sorry. So I'm expecting part of this gap to get filled at some point. So that's what I'm looking for, is to come back in this level at around 21 days to expiration for March the 17th. I'll be again looking to roll this up to 110 and offset that debit by manipulating my put strike as well. So that's what I'm looking at over here, and that is my two positions where I actually own stock. The third position is what I've had on for a few weeks now, is AMC. So just to show you on the tracker, and where's it gone over here? Again, I got another short strangle, but this is a traditional short strangle where again you can see the put strike is lower than the call strike. Again, I generated $510 back in week 26. And again, I'm holding this position for about $10K in buying power. I have to make this really small so you guys can see. So I own the 2 put and the 23 call. I'm fairly comfortable with this position. It just sits there. I only did it when I was on, if I wasn't on a cash account at the time, I probably wouldn't have made this position, but it's there. I don't think AMC will go to 2, and I don't think it will short squeeze up to 23. I tried to bring these strikes down, but the liquidity wasn't really there. It wasn't really doing anything with such a wide bid-ask spreads. I just left it like it is. And again, it's going to be pennies to the overall piece. So I'll probably just let this close out and see if there's another opportunity within AMC at some other point. And lastly, I've opened, similar to Tesla, a short call position with 3 contracts. Coinbase again has also made a massive run up, which you can see over here. It's down 7.64% today. I might sell a put against this and make this position into a strangle. So currently I've got the 120 strike price, and that's 11K in terms of buying power that is using up. Again, we want Coinbase to stay below 120. So what's that? So 69 even. So 120 minus 69, that's 51. Pretty much, actually. 51 divided by 69. It pretty much has to double to 86%. So what I'm going to do, what I'll do at some point today, I'm going to move this strike down probably to the 100. I am also conscious that Coinbase does have earnings. When is the earnings? The earnings is on the 21st of February. So I'll be looking to roll this position before the 21st. I think we'll be just above the 21-day mark until I look to roll. But I think I might decide to roll this call down to generate some more premiums for week 29. So my potential trades for next week is to roll this call down, potentially add a put in there as well if the IV and the IV rank is good. And just looking now on here, Tesla might do something with the strike, so I might start to put a covered call down. If Tesla starts to go down slightly, I might look to roll down that call, and then also to look at what other potential new trades there could be. So again, the way I'm going to try and make income on a weekly basis is by repositioning my strikes, adding in additional calls or puts, additional contracts in existing positions, and again, looking at new positions to sell premium in. Again, it'd be inconsistent in terms of the weekly income trying to come in, but overall there should be 1 or maybe 2 weeks of, you know, me extremely over exceeding, which will compensate the weeks where I shortfall. So I really hope you've enjoyed this video. On the screen now is a step-by-step example live trade, not on this portfolio, but another portfolio, of me doing a live strangle position, which has gone wrong. It is on Tesla. I'm now currently inverted, but that's not on this particular video. But I would check that one out so you can see how you can manage these types of positions when trades go wrong. So hope you've really enjoyed this video, and I shall see you guys in the next one.